Hi everyone, my name is Alana Danowski. I am the marketing coordinator for Withum's consumer products team. Thank you for joining today's Restaurant Revitalization Fund webinar. Today's program will be presented by Terry Moncrief, Kathy Ennis, and Jeremias Ramos. Before I begin, I just have a few housekeeping notes. The materials for today's presentation can be found in the toolbar located at the right of the screen. Also at the toolbar, at the bottom of the toolbar, you'll see a question box. Please feel free to enter any questions throughout the presentation. All questions pertaining to the webinar content will be answered at the end. We'll do our best to address them. We will be emailing out a copy of the recording and the slide deck after the presentation. And finally, once the webinar is over, there'll be a pop-up asking you to complete a survey of today's webinar. Please take a moment to complete it. It's our best way of being able to provide you with the best and most relevant programs possible. So with that, I'm going to turn it over to our food and beverage leader at Withum, Terry Moncrief.
Thank you very much, Alana. And Alana, I thank you for coordinating this and for running the difficult part of the technology. My name is Terry Moncrief. As Alana mentioned, I am in charge of Withum's food and beverage team. I have quite a good team behind me there. The food and beverage team is within our consumer products niche run by Glenn Bellamy. And within the food and beverage team are the presenters you're going to see today. We do quite a few restaurant clients, and that's why we kind of need to keep up on this type of stuff. Withum Smith & Brown, just real briefly, is a very large regional tax audit and advisory firm. We have, like we said, quite a few clients in the food and beverage niche and in the restaurant industry. Last year was a very interesting year for restaurants, and you know, everything that we went through and some shutdowns and some issues and some difficulty and the PPP and the employee retention credit and PPP2 and now this restaurant revitalization fund. There's been a lot of activity, and there's been a lot of activity outside of the traditional tax and accounting services, but our advisory team has done a very good job, and you'll see today, I hope, between Jeremias and Kathy, the good job that we've done, or that they've done mainly on the advisory side for restaurant clients. So let me launch right into introducing my presenters for today. So presenting for us is Jeremias Ramos, who is a manager in my tax department and is the individual who we kind of put in charge of diving into and absorbing this entire bill. I'm sure he's read every single word in entirety, and he'll explain that to you a little bit later. And in addition, Kathy Ennis. Kathy is a partner down in my Orlando office, and Kathy is in our food and beverage team within the consumer products niche. She is partner of very many restaurant clients. So with that, we'll get started, and Kathy is going to begin for us. So Kathy, it's all you.
Great, thanks so much, Terry. Thank you to everybody for joining us today. And it's no secret to the people on this webinar what a tough year 2020 was for restaurants. What we're going to cover today is the Restaurant Revitalization Fund, eligibility for the grant, how much money you can expect to receive, how do you apply for the grant, and what's the catch, if any. So hopefully by the end of today, you'll be a little more well-versed on this program, and we'll be able to talk you through some of the specifics that we know at this time. Next slide, please. Can you go to the next slide, please?
Do you not see the slide?
Oh, okay, I'm sorry. Yeah, I see it now. Okay. So anyway, I think it's, as we've discussed, it was a rough year for the restaurant industry in 2020. We really were on the front lines of the pandemic, and you know, the initial closures or reduced capacity restrictions took everybody, you know, it seems like one week everything was kind of going along as normal, and then the next week everything stopped. So the restaurant industry as a whole, it's estimated that 110,000 eating and drinking establishments either permanently or temporarily closed. Roughly 2.5 million jobs were erased, and an estimation of $240 billion of lost revenue. I was thinking before this presentation, from where I sit in my office in downtown Orlando, I'd say there's eight places that I can think of that are within a half a block, 2 blocks of me that are closed permanently. And that's just what I could think of off the top of my head without really diving into it. So I know that it was widespread for closures, and hopefully better days are coming. We're approaching the 1-year anniversary of the CARES Act, and there were 2 major pieces of legislation and relief that were part of the CARES Act that we're going to just touch briefly on before we launch into the Restaurant Revitalization Fund. Next slide, please. So I think everybody by now has heard of the Paycheck Protection Program. So that was part of the CARES Act, and it helped thousands of restaurants keep their employees on staff. The parameters of the program were very helpful to many different companies throughout industries that were harmed, but the restaurant industry is a little bit different, where our payroll costs are traditionally lower and rents are higher. We were able to transition a little bit from full service restaurant to takeout, and the capacity limits also impacted our restaurant industry staffing by 20% or so. So there are a lot of things in our industry that made the Paycheck Protection Program valuable, but also maybe not as powerful as it was for other industries. So the National Restaurant Association lobbied pretty hard with Congress throughout the year to get some targeted relief for the restaurant industry. Next slide, please. The Employee Retention Credit was also part of the CARES Act, and unfortunately, when it was first launched last March, it was an either-or concept with PPP. So most clients that I have and industry-wide, whether they're in the restaurant industry or not, kind of went the PPP route, and not many participated in the Employee Retention Credit Program. The Consolidated Appropriations Act that was passed in late December allowed businesses that received PPP funds to now also apply for the Employee Retention Credit if they met the qualifications for the credit. So that change made that retroactive for 2020, as well as extending the Employee Retention Credit through June 30th of 2021. And then, of course, the American Rescue Plan Act of 2021 extended the Employee Retention Credit through December of 2021. Obviously, there were changes in how the program was operated for 2020 versus 2021, but it is a valuable benefit that we have addressed in other webinars. So we're going to now talk today about the Restaurant Revitalization Fund. So next slide, please. So what is the Restaurant Revitalization Fund? The American Rescue Plan created a $28.6 billion fund specifically targeted to the restaurant industry, and it specifically targets small restaurants. There's a preference towards women, veteran, and minority-owned restaurants in the beginning of the program. We'll talk a little bit more about that later. And it specifically excludes large chain restaurants and publicly traded company and restaurants that are owned by publicly traded companies. So we will talk a little bit more about the eligibility as we go through, and then Jeremias is going to take over the next few slides.
Yep, so I think the question that a lot of people have when they're looking at this program, of course, is how much money can I receive? And just to make it a little exciting here, pretty much the grant money that you would receive is going to compensate you for your loss of revenue when you compare 2019 to 2020. So in a basic example, if you had $1 million in gross receipts in 2019, and then for 2020, the pandemic really hit you hard, your gross receipts are down to only 500,000, you can get a grant worth of 500,000. So it's definitely a major program designed for restaurants, especially those on the smaller end, that can really make that 2020 loss year into a year that's kind of a sounding board or a trajectory into the future, where you can get some grant money, really hold you over, and then once everything opens up, you can really, open up your restaurant and expand for the future. So the maximum amount for an affiliated group is going to be $5 million per location, for a maximum for affiliated group of $10 million. So if you have 20 locations, you have to just divide that up, and you can't exceed more than $5 million for a particular location, or $10 million in the aggregate. Also, another thing to consider is that the grant is reduced by any PPP funds that you received in 2020 and 2021. So as a quick example, if you had a $1 million drop in gross revenue, you took a 500,000 PPP loan, the grant would be reduced down to 500,000. So it's a nice way just to recoup any losses. And then we'll show later slides how to maximize benefits between PPP, ERC, and then also this new program. So as an example for a small restaurant, you have gross receipts for 2019, let's say we're 600,000. Because of the pandemic, because of different restrictions, let's say you have 50% capacity reduction, the gross receipts for 2020 now dropped to 200,000. So this 400 drop in revenue would be the eligible grant for 2020, assuming that you did not receive a PPP loan. And then if you look at an example of a large restaurant, let's say you have many locations, let's call them location A, B, and C. You had $10 million in gross receipts, $5 million in gross receipts, and $9 million in gross receipts. So for each one, you're just going to calculate what that reduction in gross receipts are. So as you see, you have a $6 million drop. You have a $5 million grant for that specific location, location A, because you can't receive more than $5 million per location. And then location B, you see there's a $3 million drop. So that location would be eligible for a $3 million grant. And lastly, if we look at the last location, it's a $6 million drop, but you're only eligible for $2 million for that location because the overall cap is 10. So even though there's a cap at 5 per location, here you have to aggregate the total amount. But still $10 million over several different locations is a considerable amount of money, especially when you're talking in excess of PPP funds and other programs that are still available. So as an example, if you did take PPP funds, you would just have to reduce that eligible grant by that amount. So in the example of a $600,000 gross receipts restaurant for 2019, if your gross receipts decline to $200,000 in 2020, you're showing a $400,000 drop in gross revenue. So normally you'd be eligible for a $400,000 grant, but in this case, if you took $100,000 in PPP1 and PPP2 and combined, you would be eligible for a $300,000 grant. So now we'll discuss some eligibility requirements. I think Kathy, you're going to cover this section, right?
Right. Okay. So for eligible entity, everything that shows on your screen right now was specifically listed in the Act as a type of business that would be eligible. So, you know, restaurants down to saloons, and I think they've covered a wide variety of places that we could go to either have food or drink with each other. And the next slide, there's a more simplified eligibility threshold, and it's basically a business where public or patrons assemble, and the primary purpose is being served food or drink. So I think that's a very broad definition, and it covers, obviously all of the, businesses on the previous slide, but, we've kind of looked at a few other situations to see what we think would qualify. If you could go to the next slide. So I think you could make a case for eligibility for an ice cream stand, a bakery, something with specialized desserts, a chocolatier, farmer's market, or a deli. I was thinking I have a group that has some coffee restaurants that also serve pastries, so I think they would qualify as well. So anything where people go to specifically to have food or beverage would qualify. A few, say, businesses that we thought of that would not qualify, if you go to the next slide, say if it was a nonprofit dinner, like a gala or a networking event, that's not really a business. Wholesale distribution of food products, the public doesn't assemble there, so they would not qualify. In a grocery or convenience store, food isn't served as a primary purpose of those businesses. So I think those things we would look at and say that they don't qualify. The next slide lists the businesses that specifically were listed as not eligible for qualification in the Act. So state or local government businesses and businesses that as of March 13th, 2020, own or operate together with any affiliated business more than 20 locations. So this is one of the key points in the definitions. So it's regardless if it's under the same or multiple names. So if you have somebody that has, say, 40 different locations of a franchise, I don't think they would qualify. If they're, and the next item is if they have a pending application for or has received a shuttered venue grant. And the last one, most importantly, I think the publicly traded companies, there was a lot of press about the PPP funding that was applied for by different companies that, you know, the restrictions of that program initially allowed anybody to apply for the loans. And then there was, I think as this new bill was drafted, they learned their lessons with some of the things that were not very clear the first time around and added some specific exclusions. So none of those entities would apply. And then Jeremias is going to talk a little bit more about the definition of an affiliated business.
So as Kathy mentioned, if you have 20 or more locations, you are not eligible for this grant program, which is pretty exciting if you are an owner of less than 20, because as we've seen in the past with PPP funding, especially the first round, you had a lot of smaller restaurants, a lot of smaller businesses kind of crowded out, and a lot of issues where you had large publicly traded companies, maybe businesses that were larger, didn't really need the funds that they were getting more priority just because they had better access to banks. So in this case, we'll see affiliated businesses, especially if you have less than 20, you're on the smaller end, that you're going to get priority. And this is a great way to kind of get access to those funds before those larger businesses. So the term affiliated business for this grant program is going to mean a business in which an eligible entity has an equity or right of profit distribution of less than 50%. There is also a provision that looks at if you had contractual authority to control that business. So you could have a restaurant group that maybe is not controlled by the same group of people who own more than 50%, but they have common control. So you could have the same affiliate group, maybe it's a franchise and it's controlled by the same management. In that sense, they kind of get you on both ends. So it's not only the 50% ownership rule, but it's also the common management of the day-to-day operations. So the easy way to understand this is just looking at common ownership of more than 50% or common management. And this is probably going to be across the board. So if you have a large group of companies, you're just going to look at this simplified test. Chances are, if you think you have an affiliated group with a substantial number of locations, entities, and you're over 20, you're probably going to be excluded. Just because there is that added element of common management, where we saw it in different examples. If they cited, for example, 163J, there were different rules when it came to that common ownership. So in this sense, if you have common management, common ownership, you have many different locations, and it feels like you have that affiliated group, chances are you do. As Kathy discussed previously, there is some priority when it comes to allocating the funds. So the first $5 billion, which represents about 21% of the total funds, will be set aside in the first 60 days for any eligible entity that has $500,000 or less in gross receipts. And then also the initial 21 days, the SBA will prioritize certain businesses that are owned by women, veterans, or socially and economically disadvantaged groups. That's mostly going to be targeted towards different minority groups. They give a broad definition of what that means, but in a sense, if you're an individual who historically faced social prejudice or economic disadvantages, that you most likely would fall into that group. Now we're going to discuss some eligible expenses. So as we discussed, the grant amount is considerable, but what can you use the funds? So it's going to be pretty common or pretty similar to the PPP funds, but with some differences. So an eligible entity that receives a grant must use the funds on allowable expenses. You can't just receive the funds and distribute it to partners or kind of use the funds any way you see fit. There is some requirements that you must use it for allowable expenses, but the legislation is pretty broad when it comes to these allowable expenses, and they give applicants a lot of flexibility. The first one is that the covered period for these expenses is going to be from February 15th of 2020 through December 31st of 2021, which means if you receive a grant, let's say in May, you can look back all the way back to February 15th of 2020 and allocate those expenses. So if you're a restaurant who did not receive PPP funding, you had a lot of expenses from February 15th until May, you can, in a sense, allocate all of those funds to those expenses. And in a sense, the government is compensating you for expenses that you already incurred. So if you receive a $500,000 grant, for example, you already allocated those expenses. You can use that grant money going forward on any purpose that you want. You can use it to, build out your restaurants. You can use it for distributions. In a sense, as long as you can show that you have those eligible expenses and you're utilizing those all the way back from February 15th, all the way to the end of this year, you can exhaust all those funds and they won't have to be paid back. Also, the SBA has the power to extend that period out 2 years after the date of the enactment. So we're looking at March of 2023. So I was having a discussion earlier with another partner in our group that essentially they were saying a lot of these restaurants, they might not have those allowable expenses and they might have to pay a considerable amount back. So if you're closed down, if you have 50% capacity, or maybe you're only allowed 20% capacity in your restaurant, chances are you're not going to have a lot of staffing. Maybe you didn't pay rent. Maybe your utility bills are down, your supplies are down. You're not going to have a lot of expenses. So although you might have a massive decrease in your gross receipts, there's not a lot of expenses to go around. So what I think will happen if the SBA extends that out to March of 2023, it allows restaurants more time to use up those funds, which gives them more leverage going into the future, especially when things start to open up. They can really change around their business to accommodate maybe more outdoor dining, maybe more takeout, maybe increase their infrastructure to handle how restaurants are going to be looking after their pandemic. And then lastly, entities that close or do not use the funds for allowable expenses must return the funds. So if you receive the grant and unfortunately you close in sometime in 2021, you'll have to just return any funds that weren't used for those allowable expenses. But remember, you have the February 15, 2020 date, so you could look back, allocate those expenses, anything left over you have to return. So just giving a brief overview of some of the allowable expenses, you're going to have payroll costs. It's the same definition under PPP, so you still have that $100,000 cap. You have principal and interest on any mortgage obligations, rent, utilities, maintenance. It also includes any expenses that you use for constructing, let's say, for example, outdoor dining. It includes supplies, food and beverages expenses, any other operational expenses. And I think the big thing is that the legislation leaves it open to the SBA to kind of determine any other essential expenses. So not only did they broaden it to be expenses similar to PPP, but they also extended to additional expenses and also expenses that the SBA might determine to be essential in running operations of a restaurant. So we could see a lot of these restaurants being able to allocate these expenses and use up all those funds. So there is interactions with other programs, mostly the concept of double dipping. So you can't double dip when it comes to the ERC, but also nothing specifically excludes double dipping with PPP, but they kind of get you on the front end. So the amount of the grant is going to be reduced by those PPP funds you received. So if you're eligible for a $500,000 grant, you received a $100,000 PPP loan, they already knock you down to $400,000. So in a sense, they're already accounting for that double dipping. But I think the important one is for ERC. So it's definitely a calculation you want to do because that is a credit that restaurants will be eligible for, especially for 2020. That could be pretty big. And especially for 2021, as we look forward, as some of the restrictions are still going to be in place, most restaurants, as their gross receipts start to tick up, they might still be eligible for these credits. So we'll just look at a brief comparison of some of the expenses for the RRF versus the PPP. So we still have the same general expenses. So any expenses that you could use for PPP generally is going to be used for RRF. Since that covered period is much longer for RRF, you could look outside of that covered period and kind of allocate those rents, utilities, payroll expenses, software, and all those other updated provisions such as any property damage, worker protection, PPE, all those expenses will be in. There's also a list of other expenses that are not included in PPP, but they're included in RRF. A big one is maintenance expense. So if you have to do any general repairs, you have to fix any machinery, that's all going to fall under maintenance and expense, and you can use those funds for RRF. There's also food and beverage expenses, which is pretty big, and also those operational expenses. So if you look at it as a whole, there are definitely more expenses that you can allocate for RRF. So we can see restaurants who receive substantial grants, they have more leeway when PPP kind of restricted them. So there is no cap when it comes to, you know, that 60-40 rule for PPP versus RRF. So restaurants, let's say, for example, you're in the heart of New York City, you're paying astronomical rent, you're doing a ton of sales, but the thing is your payroll cost might not be that high. So in this sense, you're getting more flexibility when it comes to the RRF that you didn't receive under the PPP program. So some similarities, as I mentioned, it doesn't have to be paid back if you use up all the allowable expenses, just like the PPP. The good thing about this is that there's no kind of the loan forgiveness process of calculating FTEs and going through all of that. What you will have to do is just allocate those expenses. As long as you have those expenses, you won't have to pay it back. Anything that you have in excess that you haven't used up during that covered period, which would be by the end of this year, or any extended date that the SBA allows, those funds will have to be paid back. Another exciting provision that they added was that the expenses are deductible, and it's going to be non-taxable income. So this is both for PPP and for RRF. So in a sense, the government is compensating you for payroll, they're compensating you for your drop in receipts, and all of this money, you get the double benefit of allowing to deduct those expenses as well as picking up that non-taxable income. So this would be a huge benefit for those restaurants. And then lastly, as I mentioned before, there's no 60-40 split when you calculate what the RRF expenses will be. This was that limitation that I mentioned about the PPP program, that you needed to have 60% used for payroll and then 40% used for those other expenses. Now comparing it to the ERC. So there is this program, the ERC. If you aren't aware of, we do have other webinars that kind of dive into it, but I'll briefly touch upon it here. So for RRF, you have the payroll and non-payroll costs, versus for ERC, it's a credit just on those payroll costs and certain health benefits that you paid during certain periods of time in 2020, as well as is extended into 2021. The RRF is a dollar for dollar grant. So you want to prioritize to the RRF because every dollar you use in grant money is free money, versus the ERC for 2020 is a 50% grant on those expenses, and for 2021 is going to be a 70% credit. Deductions for RRF, they're, as I mentioned before, still deductible, non-taxable income. And then for the ERC, unfortunately, it's going to reduce those expenses. So although they say that it's not taxable, if you're reducing my expenses, you're increasing my tax. And then lastly, there's a short window to apply, and there's limited funds for the RRF. So restaurants who unfortunately won't be able to receive those funds or those grant monies, they can still go back for the ERC. They can amend their 2020 returns. They could look forward for 2021 and claim those credits going forward. There is no window of time that it's going to limit you. You can apply for that. I believe the statute of limitations is 3 years. So it gives you more flexibility and claim that credit if unfortunately you're not able to get any of that grant money. So there's a lot of programs out there, especially for restaurants, that you can maximize benefits, especially PPP funding, ERC, as we mentioned. and this new grant program for restaurants, the Restaurant Revitalization Fund. So there is a way to maximize this benefit. What we're doing for a lot of our clients is already maximizing PPP forgiveness and maximizing the ERC credit. This will just add another equation to our formula of maximizing those benefits. But for the most part, PPP 1 and 2 is going to be more accessible, especially for restaurants, smaller businesses. I know the PPP 2, the window to apply for that is kind of closing. A lot of banks are closing their application periods. I think there is legislation going through Congress to extend that period of time because there is still funds in that program. But remember, you still have that 60-40 split, so you still have those restrictions there. Versus the RRF can be a considerable grant, but it is limited to certain groups. It is limited to certain restaurants. So definitely, if you receive that grant, try to push more non-payroll expenses that you couldn't allocate from PPP onto that grant program. So you're maximizing the benefit there. And then lastly, ERC. Remember, it's not a dollar for dollar, and it does reduce expenses, but you still can get a considerable refund. Consider for 2021, it's $7,000 per employee per qualifying quarter. So if you're a restaurant, especially in locations like New York City, New Jersey, there doesn't seem to be a time limit or kind of a window of time of when everything is going to be opened 100%. So if you're still getting restrictions, especially 50% capacity limits or even 75% capacity limits, you're still eligible for that period of time. And in a sense, the government is going to pay 70% of your wages up to $10,000 per employee. So just considering if you have an employee who earns, let's say $40,000, $10,000 per quarter, the government would give you $7,000 back for each quarter for that employee. So it could definitely be a considerable amount that you receive. So if you maximize all three benefits, PPP, RRF, and ERC, you could take a lost year for a restaurant and turn it into an opportunity going into the future of receiving a lot of these grants, a lot of these credits, a lot of these funds in order to build back even better. So just as a quick overview of how to maximize all three. So in a sense, if you think about it like this, the government's going to pay you for the ERC credit 70% of wages on your first $10,000 per employee. If you did receive PPP2, the government is paying those wages that are not used for ERC up to $46,154 per employee. And if you receive the RRF, the government is going to pay all those operational costs, all those other non-payroll costs that would have not been eligible for PPP forgiveness or for ERC credits. So the question is, how do you apply for this program? So we went over everything in regards to the various functions of the program, how much money you can get, what eligible expenses, but a lot of questions we've been receiving recently is, how do I apply for this program? So it's going to be a little different than the PPP program, just because the mechanisms will be different. So the PPP program, the SBA had the luxury of kind of falling onto the banks and using their infrastructure for a lot of the application. For this time around, it's going to be directly with the SBA. So we're still waiting for guidance. We're still waiting for the SBA to kind of open those applications and tell us which restaurants are going to be eligible, what's the ordering of the applications, what should restaurants kind of do right now to gear up to apply for that application. But generally, what we're looking at and what we've seen from different associations is that they're advising clients to do some things just to prepare for that application process. But as of now, unfortunately, we don't have enough information to give to clients to get them ready for that process. But if you are certain groups of individuals, a woman-owned business owner, veteran, a minority-owned business owner, there is a self-certification process to expedite the process in the first 21 days. So you definitely want to be on the lookout. You definitely want to apply within that period of time, just so that you can, in a sense, get that added priority and get those funds sooner. So if you're that you fall within that group, definitely something you want to keep checking on the news with. If you partner with a advisor or a CPA, they should be able to walk you through that process and kind of let you know when the application is open, so you're not scrolling through, Google and different news programs that probably are not picking up this program that won't tell you, oh, the application is open. This is exactly what you need to do. So what should you do to prepare? So the SBA will prioritize the ability of each applicant to use their existing identifiers over requiring other forms or registrations. So if you have an EIN number, if you have other identifiers that you've been using to prepare tax returns, most likely you're going to be using those. However, I was on a webinar with the National Restaurant Association, and they recommended taking these additional steps before the application window opens. And mostly because in this time around, you're going to be working directly with the SBA. So they're kind of mirroring the program to other programs and other grant programs that are available to different business owners and how that process generally went. So there's 3 steps that they're advising their constituents basically to prepare for the RRF. So the first is to sign up and get a DUNS number. This is a data universal numbering system. It's a number that generally is used when tracking a business for certain grant programs. Next is going to be, you're going to register with the U.S. federal government system for award management. This is SAM.gov. It's free to sign up. It takes about 2 weeks to process. So definitely it's something you want to start the process now, getting the DUNS number first, registering at SAM.gov. And then lastly, there's this additional step of sending a notarized letter just to confirm all your information. What this does is it sets you up and gives all the information needed to the government. So if you wanted to apply for this program, they already have all your information available. So it kind of speeds up that process. But the thing is, we don't really know what the process is going to look like, but it doesn't hurt to follow these steps that were recommended by the Restaurant Association to basically maybe give you a leg up when the application process opens. One thing is, especially with limited funds, you don't want to be one step behind someone. If you took additional steps and it turns out you didn't need to take these steps, you'd rather be in that situation than be in a situation where unfortunately you don't get any funds because you applied too late. So I would recommend just downloading these slides and definitely keeping them for your records. I kind of breeze through kind of these steps of setting up because they are step-by-step of how to get it. And if you're just listening to this, you're probably going to forget it, the website later on. So definitely download these slides, follow these steps. If you want to set up a DUNS number, if you want to register at SAM.gov, the DUNS number is a 9-digit unique identifier. So if you don't have one already, you can sign up one for free. The website is www.dnb.com. You can do some research of what it's used for. It's not only used for grant programs, but other ways. I've seen it used for certain distributors. Let's say, for example, you're a restaurant and you have really good hot sauce. It kind of connects you with other distributors so you can, in a sense, sell that hot sauce at Costco or something. Next is signing up at SAM.gov. So I would say it's extremely important first to sign up for the DUNS number because SAM.gov is going to reference that DUNS number and all the information when you use to set up that DUNS number. And it's quite annoying because if you spelled anything wrong or if you used the period after corp or LLC or you put a comma in, it's going to look exactly at that information. So I've had some applicants call me and say, for some reason, it's saying that my information doesn't match. So what you want to do is make sure whatever you put on your DUNS number is going to match exactly on your SAM.gov account. So you're going to go on, you're going to create an account. There's going to be a questionnaire. You're going to fill out all your information about your entity. They're going to ask about what type of entity it is, and kind of go through that process of answering all those questions. And they do ask a question if you want to bid on government contracts or if you just want for certain federal assistance. So in that case, if you're strictly going to SAM.gov just for the RRF, there is a checkbox that just says, I only want to apply for federal assistance opportunities like grants, loans, and other financial programs. So it kind of reduces the amount of information you have to fill out and speeds up that process. The next step is the core data section on SAM.gov. So completing the core data section is going to take a little more time because they're going to ask a lot of questions. They're going to want you to validate that DUNS information, enter any business identification numbers, and create a marketing identification number. There's a whole bunch of steps here. So I know we might have some questions that we want to take at the end, so I'll just breeze through these slides, but definitely keep them for your records when you go through, so you can follow step by step when you go to SAM.gov. Also, more information about point of contact, the more sections that you have to fill out. And for the most part, I took all this from the National Association of Restaurants, the really helpful guide to take you through the process and completing that application at SAM.gov. And then the last step they advise is that notarized letter. So there are some templates you could fill out that I included in this PowerPoint, and different things that you want to include in that letter, how to exactly send in that notarized letter. What this does is essentially, it's the last step. It's almost a like a 3-step protocol where you sign up, you enter all your information, it's correct, and then also you need to download this notarized letter, put your letterhead on top, send it to them so they know that yes, this is exactly you, this is your business, and it sets you up, make sure that you are exactly who you say you are. So I think with that, I'm gonna kick it back to Kathy to kind of discuss some points that you wanna, I know we threw a lot at you, so it's definitely a good time to pause and take our breaths and discuss the future of the program.
Yeah, I think there's a lot of information and obviously a lot of unknowns at this point in time. I do think that while the program is, just formed a few weeks ago, the SBA is still working on, their guidance. I think in this last year, the SBA and Congress have learned a lot about how to address questions people would have before these programs are signed into law. So this one seemed to have some of the questions that haunted all of us all of last year about the PPP funds and taxability. And okay, if the proceeds aren't taxable, then the IRS said that the deductions were not deductible, and then that all got resolved at the end of the year. But that was addressed on the front end with the Restaurant Revitalization Fund. Do remember that the process for getting the DUNS number and registering with SAM.gov are free. So I think all guidance seems to be indicating that those are going to be required to participate in this program. So I think it's a good use of your time to start that process now so that when the program launches, you have that piece done. Again, it's free, so it shouldn't cost you any money to do that. And I think it's important to partner with a trusted professional who has a track record of helping you out in these situations. And really, before you launch into getting a DUNS number and this, registering with SAM.gov, take a look at your 2019 and 2020 gross receipts and remove your PPP funds to see where you're at, because it could be that you don't qualify for the program. It could be that you do, but you want to just have a ballpark of where you think your maximum grant is before you launch into doing any of these applications. So that's something I would recommend you talk with your CPA or trusted advisor, or if you don't have anybody, we would also be happy to help you. So there were some frequently asked questions addressed that Jeremias has already prepared, and he'll walk through some of those, and then we'll be happy to answer any other questions at the end.
So there are a lot of questions that we've had clients come and approach us asking, and a lot of the questions we have difficulty answering just because we don't have enough guidance from the SBA. But there are questions that we're able to answer. One specifically is, what if I started a business in 2019? So if you started a business in 2019, chances are you can't really compare your 2020 gross receipts to 2019. So if you started a business, let's say in July of 2019, and you had a full year for 2020, your gross receipts are not going to look comparable, mostly because you have half a year for 2019 and a full year for 2020. In this instance, what the legislation allows you to do is annualize your gross receipts for 2019 and 2020 and compare them. So in a sense, in an example of a restaurant that opened in July of 2019, if they had an average gross receipts, let's say from July to December of $100,000, in 2020, the same restaurant had gross receipts of $500,000, they would be eligible for a $700,000 grant. And the way that works is essentially you take $100,000 in gross receipts, annualize it out, multiply that by 12, you have $1.2 million in annualized 2019 gross receipts, less that $500,000 in 2020 gross receipts. So although the gross receipts were, let's say, $600,000 in 2019 compared to $500,000 in 2020, you're still eligible for a substantial grant just because they allow you to annualize those gross receipts. I saw someone posted a question in the chat, basically asking, what if you started a business in 2020? So for 2020, you don't have any gross receipts in 2019, so there's nothing to compare it against. But the legislation does allow businesses started in 2020 to compare their gross receipts for that year in comparison to their allowable expenses. So definitely, if you're a business that started in 2020, you want to start that process of looking at what are those allowable expenses, what are your gross receipts, so that when the application process opens, you have all that information available. So for example, if a business started in February of 2020, had total qualified expenditures of $700,000 and gross receipts of $500,000, in a sense, they're running a operational loss of $200,000. In this case, you would be eligible for a $200,000 grant. So an easy way to think about it is the government, in a sense, is compensating you for your cash operational loss for 2020. So if you take your allowable expenses, netted against your gross receipts, those are going to be the loss, in a sense, that you're reporting on a cash basis, because it doesn't include amortization, depreciation, some other capital expenditures. So in this example, even though you opened your business in 2020, you're still eligible to apply for the grant, and you can still receive a considerable amount of money. Another question is, do I count my non-restaurant locations? So an example would be, if you're a business owner, you have 25 locations across your business enterprise, you have 10 restaurants, 5 car washes, 5 convenience stores, you have 5 gas stations. In this case, it's unclear if the SBA is going to only include those restaurant groups and kind of exclude all those non-restaurant locations. But based on the wording of the legislation, it's unclear. So it would be, in a sense, if you have a ton of car washes or a ton of other businesses, it would hurt those businesses if they had to include all of those locations, not just the locations that are restaurants. What if you have a mixed use business? So in a sense, if you have a deli and you also have a convenience store that's in the same location, how is that going to work? There's no guidance yet, so the default would probably be to look at those codes that are reported on your tax return of what kind of business it is. But hopefully the SBA comes out with guidance. Maybe there's a way to kind of bifurcate a certain business, that if you are a deli, you're serving food, people do come to purchase food, but you also have a convenience store built into that business. Maybe you can exclude that portion and only look at the deli or only look at that restaurant. We will see instances where you have maybe a restaurant and arcade, or you might have businesses that, in a sense, they're a restaurant, but they're also not a restaurant at the same time. So how is that exactly going to work? And with that, we're just waiting for more guidance on exactly how the SBA is going to treat those businesses. Another question is, do I apply separately for each business? So most likely it's going to be similar to the PPP application process. So each eligible entity can apply for the grant, but remember, there are those aggregate max rules. So it's that $5 million per location and then $10 million in the aggregate. So probably what they'll make you do is that if you have several locations, you have several restaurants, they're set up as separate LLCs with different EINs. They file different tax returns, for example. Those most likely you'll apply separately for each entity, just as you did with the PPP funds. But there are those affiliated rules where you have to look to make sure that you don't have more than 20 locations and you're not taking more money than you should based on those aggregation rules. And with that, that covers all our informational portion of our webinar. We do have about 9 minutes, so we do have some additional questions. If you have any questions, feel free to drop them in the chat and we'll try to address as many as possible. So I see that we have a question about tribal-owned businesses. So just to quickly answer that, the legislation does include tribal-owned businesses. So if you're a tribal-owned restaurant, that would be eligible.
Mm-hmm.
Another question is, how will RRF money be allocated to eligible businesses? Will funds be distributed first come, first served? Kathy, do you want to answer this one?
Yeah, I think that's still something that's to be determined. I remember seeing a small little carve out in the legislation that SBA may allocate funds based on different regions and costs in that region. So I think depending on the demand, you might see they could, do some adjustments to the amounts that are given out. But again, I think it's too early to know what the end result will be. I think what would be most important is for people to be able to get their applications in as soon as they can. I don't think it's going to be a FIFO, first come, first served, but I do think that there are going to probably have to make some decisions at some point down the line. They did have the carve out for the first 60 days of $5 billion in funds for the entities with gross receipts of 500,000 or less, and then also the 21-day period for the women, veterans, and disadvantaged groups. But I just think that it's too early to say.
Mm-hmm. I would agree. We have another question here that says, what if I was forced to close my restaurant in 2020? Would I still be eligible for the grant? Because it looks like they would be able to open their restaurant if they receive those grant funds.
Mm-hmm.
So I would just say that there's nothing that precludes a business that closed in 2020 or 2021 from going back retroactively and claiming the credit or claiming the grant for those expenses. Remember that it is retroactive, so it looks back to February of 2020. But remember, this is a grant program that's run by the SBA. It's not a program that, in a sense, like a credit where if you're eligible. In this sense, they're going to prioritize some businesses over others. So it's unclear if they're going to prioritize businesses that are still operating versus those that have closed. But only time will tell based on the guidance that they're going to come out with within the next couple of weeks. Another question is, if I open a business in December of 2020, am I entitled to receive any portion of the grant? Kathy, do you want to answer that one?
Yeah, I think that, again, that would be the difference between your receipts in 2020 and your expenses in 2020. So if your allowable expenses exceed your receipts, you would be eligible for the grant for that piece.
Mm-hmm. And then I would also add that there's a provision in the law that if you're starting up a restaurant before the enactment of the legislation, so before, I think, March, I forget what the exact date was, they'll let you use some of those expenses as well. So if you open in December and you had some expenses, the startup expenses, allowable expenses within that period of time, they will allow you to allocate those as well. Another question is, what if you're purchasing a business? Would you be able to kind of look back and claim it for that business? So I would say it depends on how it's structured. If you, for example, you purchase the name of the business, you purchase its assets, in that case, you might not be eligible just because you're bringing that business kind of into your business. Versus if you purchase the LLC, for example, it has the same EIN, it's still continuing operation. I think in that case, you probably have a good chance of applying for the grant just because you're stepping in the shoes of the business and it doesn't look like the business stopped operations and it turned into a new business. So I would say definitely if you're looking into any mergers and acquisitions, especially for those restaurants, you want to look at how it's structured. Definitely talk with a tax attorney, and then see would they recommend purchasing the LLC, because I know that's going to change a lot of the terms of the that purchase agreement.
Yeah, I would agree.
Mm-hmm. There's a question here about double dipping with the ERC and PPP. Kathy, do you want to quickly touch upon that, just the rules for double dipping?
Sure. So they specifically excluded any wages that are used for the ERC. You're not allowed to use for the RRF funds, but the PPP amounts have already been taken off the top of the RRF funding. So there doesn't seem to be any issue with double dipping on the PPP funds because they've already been removed from the grant. So, but the good thing about the grants is they allow, you know, when you're just limited to the wages piece of the ERC, there's so many other expense categories that you can use for the RRF funds. I feel like most people would be able to spend those funds without having to be too concerned about losing out on the double dipping prohibition.
Mm-hmm. And then I would also add that, you know, it's important to kind of take a step back and look at the whole picture when it comes to PPP, ERC, and this new grant program. There are a lot of opportunities, especially with ERC, where you can get a considerable amount of credit, 70% of wages paid up to $10,000 per quarter that you're eligible. So we could see restaurant owners getting credits, especially, you know, if you just take a staff of 20, multiply that by 70% of those wages, you could get a considerable amount of wages, a credit on those wages. So you could be looking at $50,000 to $100,000 in credits per quarter. That's well in excess of anything you would see for PPP. Also, you want to make sure to look at that grant, but they also allow you to use other expenses that wouldn't be considered for ERC or for PPP. So it's definitely going to be a process you want to work through with an advisor just to maximize that. Because the last thing you want to do is you're at the end of the covered period, you're still sitting with $500,000 in grant money, and you have to decide, you know, do I give this to my landlord? Do I have to, you know, spend the money? Do I have to give it back to the government? You definitely want to set up that process ahead of time so that you maximize all the benefits. You're not wasting any money, and you don't have to give any money back to the IRS.
Right.
So I think with that, we have 1 minute left. Terry, if you wanted to add any closing words or comments.
Yeah, I appreciate that, Jeremias. I think you and Kathy did an excellent job. I thank you both very much. It was very informative, I think, and I certainly hope it was very informative to everyone on the call. I thank you all for joining us, and please feel free to reach out to any of the three of us or anyone at the firm at any time if you have any further questions. It is a very complex calculation, this interaction between the PPP1, the PPP2, the employee retention credit. If you think about it, the PPP1 should have hopefully given us 2.5 months of our salary. The PPP2 might have been another 3.5 months. That's basically 6 months of the salary right there. And the employee retention credit could very well fill that gap for the other 6 months. But this new program allows so many additional expenses that I think it's going to still provide a really nice benefit to some of these restaurants that are struggling. So again, if anyone has any questions, please don't hesitate to reach out to us. I think that'll do it for us, right? Alana, yep. Thank you all very much.
Yeah, thank you everyone for attending. Please take a moment to complete the survey at the end. And as a reminder, we will be sending a follow-up email with the recording and the slide deck. Thank you again for attending, and have a nice night.
Okay.
Thank you all.
Thank you.